Hello and welcome to this episode of Macro Sutra. I'm TCA Sharad Raghavan, Deputy Editor, and now we know that in the first quarter of this financial year, the government's expenditure fell well short of their target. And the reason for that was the elections that happened during that period, and that was well understood. But what was also understood was that it would pick up its expenditure in the subsequent quarters and months. Now, whether this happened or not, how the government's revenues have fared, and as a result, how the deficits have been for the government. To discuss all of that, we have with you Radhika Pandey, Associate Professor at NIPFP. Thank you so much, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, we have the data for a little more than half the financial year.
Right.
We have 7 months of data, right?
Yes.
So let's start with capital expenditure because it's an important growth driver. Has capex picked up? Has the government been able to, recover some of the pace that it had lost in the first quarter?
So, if we look at the first 7 months, the April to October period, capital expenditure has actually contracted by almost 15% as compared to the same period of last year.
Right.
So, as compared to April to October of last year, capital expenditure in the first 7 months of this year has contracted by 14.7% to be precise. And also in terms of the budgeted expenditure, the amount that has been spent is just 42% of the budgeted amount. Capex. So
Right.
we know that capex budgeted has been around 11.11 lakh crore. So 42% of that has been spent in the first 7 months. So now this is very challenging because now in the next 5 months, the government will have to spend the remaining 58%,
Right.
which is a daunting task. And in terms of numbers, it translates to around spending 1.2 lakh crore every month in the remaining 5 months.
Right.
So it is that way. It is a challenging task. So there is a likelihood that the government might underachieve on its capex target because it's already on a very high base. We are expecting 11.11 lakh crore. To some extent, yes, you said rightly, first quarter expectation was that capex would contract and it would be slow, but that did not pick up materially even in the second quarter, that is July September quarter. One aspect of this, or one reason for this, have been the extended rains, which dented some part of capex normalization plans. But even otherwise, we look at both the central government and state governments, the capex normalization plans have not yet taken shape. So that is one part. The other part also is that if we look at the disaggregated level, look at the ministries where capex is picking up or where capex is lagging, there the reassuring part is that at least in the big ministries where capex allocation constituted the substantial part of the overall budget,
So
for
roads.
example, the roads and railways, which account for almost 47% of the budgeted target, their capex implementation has been more or less steady. So particularly in railways, in the first 7 months, they have achieved 62% of the budgeted target.
I see.
And similarly for roads also, they have achieved more than 50% of the target in the first 7 months.
So it's the other
It
ministries
is
that are
the
lagging.
other ministries where there is a problem. So it's it's a very important question to look at where in which ministries it is lagging, why it is lagging. Is there a case for reprioritization of capex? Because it's not that all ministries are showing a declining tendency. Some ministries are showing a pickup. So what is lagging behind, that is a crucial question. But overall, if we look at the budgeted target, yes, for 7 months the pace has been slow. It's only 42% of budgeted estimate. And also in terms of the first 7 months, we have seen 14.7% contraction, and this is primarily driven by contraction in the last 3 months. So August, September, October, consecutively each of these months have witnessed contraction in capital expenditure as compared to the corresponding month of last year. So even in October, there was contraction as compared to the October capex of last year.
But that can't be the monsoon. I mean,
Yeah,
October.
that can be the monsoon. That's what I'm saying. That it's not just monsoon. It's not just election-related uncertainty. It is a deeper problem, and it is a structural problem, and it needs to be seen. And it has implications for the budget-making exercise that has already started,
Right.
and we we have the budget coming up on 1st of February. So all these data points, these numbers have important implications for the upcoming budget. It needs to be reconsidered whether this every year keeping 20-25% ambitious growth target of capex, is it sustainable over the long run? Because there is a time lag in capex implementation. There is a capacity to absorb. There are some limits to the capacity to absorb physical investment. So all these things need to be taken into account, and therefore in that context, these numbers have important implications for the upcoming budget.
No, of course. And the other major element of government expenditure is revenue expenditure, which is basically the salaries, pensions, interest payments.
Right.
Broadly, these are the categories. These kind of expenditures are largely stable. So, is that what the data has also shown?
Yes, so that is what the data is also showing. At least for the first 7 months shows that almost 54.5% of the budgeted expenditure has been spent in the first 7 months. And here the notable aspect is that there has been a big jump in revenue expenditure in the month of October. So there is, we are seeing, because there is this expectation that the second half will see a pickup, substantial pickup in government spending. So at least in the revenue expenditure part, we are already seeing that, but not in capital expenditure.
But do we know, is it in salaries, pensions, or interest payments that has?
So interest payments is again stable part.
Right.
It's I think it's if we look at, we don't have for all the all the components of revenue expenditure,
Right.
but at least in the subsidy part we see that there is a jump in food subsidy in the month of October.
In October?
Yes, so
I
that
see.
is one thing. But otherwise we see revenue expenditure is growing at its steady pace, and it's kind of, we are seeing a normalization happening after the restrictions that we saw and after the other restriction. But now we are seeing a normalization in the revenue expenditure. But capex still needs to show a sustained pickup,
Right.
and therefore if this trend does not reverse, it has concerns for the overall quality of expenditure. We might be able to achieve our fiscal deficit, but that would be at the expense of compression of our capital expenditure.
Right, and by quality of expenditure, she means broadly the ratio of capital expenditure to revenue expenditure. Ideally, you want high quality expenditure, which is more asset creating, more growth oriented, and less of it going towards things like interest payments and subsidies and things like that.
Correct.
Right, so, okay, now that's the expenditure side dealt with. On the revenue side, let's first talk about direct taxes, which is income tax and corporate tax. How have those been doing?
So corporation tax have been a very, they have grown at a very slow pace, and it's only 1.2% growth that we are seeing in the April to October period. And if we remember, when we did this comparison, we did the interim budget discussion and then we did the final budget discussion. We saw that in the July budget, they had actually, modified, revised downwards the growth projection for corporation tax, considering that there would be some impact on corporate profitability, and so their projections were revised downwards from February to July. So that thing needs to be kept in mind when we are looking at corporation tax. So it was expected that corporate profitability would not be at a very sustained level, and that is what is reflected in the corporation tax numbers also, given that there was a high base of last year, and the other part is that the corporate profitability have grown at a very subdued pace, and therefore we have seen that corporation tax collections have been only, it has shown a growth of 1.2% over the same period of last year, that is April to October of last year. There is a growth of just 1.2%, and if we look at the budgeted growth is 12%. So it is expected, in the financial year April to March, it is expected that corporation tax should grow by 12% over April to March of last year.
And so far, it's only been 1.2.
It's only been 1.2. So that is a concern, and that was quite expected, because if we look at the firm level data, we've talked about that when we talked about the GDP expectations, that some of the firms, particularly in the metal sector, chemical sector, they have witnessed sharp decline in their profitability.
FMCG as well.
FMCG as well. So it is also a broader reflection of the not so, subdued demand, consumer consumer demand. So
Right.
it's all reflection of that. So corporation tax has not done well, but reassuringly in November there has been some pickup in corporation tax, so it will not be that bad. If we look at, this is the data till October that we get from CGA, that is Controller General of Account. But if we look at the direct taxes data from the website of CBDT, there we see that till 10th of November we see that there has been some pickup in corporate tax collections as well.
Okay.
So there are these things that we need to see, but overall till now corporation tax have been subdued. In contrast, income taxes have grown at a very buoyant pace. They have grown at a 20% is the growth rate over the April to October of last year, and the budgeted growth rate is only 13.6. So on that measure, the overall tax collections might surpass the budgeted numbers because of the strong income tax collection. So we are seeing a structural shift in the overall direct tax collection composition. Proportion of income tax is rising and that of corporation tax is declining, and that is visible in the data as well.
All right. And on the indirect tax, were you able to look at the indirect tax data as well?
Yes. So, the two taxes that have dragged down the overall tax collection are the corporation tax from the direct tax side and excise duties from the indirect tax side. So, excise duties also the growth expected was around 4.5%. That is the budgeted projection. But again, in April to October, growth is only 0.6%. Again, it is a reflection of slowdown because when consumption is lower, the tax collections tend to be lower.
Right.
But one major part of this is also related to heavy rainfall, which resulted in slower growth in diesel consumption and therefore slower tax collection. Going forward, we know recently the government has scrapped windfall taxes on crude and ATF and other crude products. So that would again have implications for excise duty collection. We could, it's expected that excise duty collection would not pick up in a substantial manner, given that one major contributor, though very small, it's not a very big contributor.
Not anymore.
Not anymore. During post-COVID time it was, but not anymore, and that is precisely the reason why it has been scrapped. But still, it would have some bearing on excise duty collection. So from the indirect side, it is the excise duties that have dragged down the overall tax collection. But if we broadly look at the GTR, that is the overall gross tax collection, gross tax revenue, it is the budgeted growth is also 10.8, and in April to October also it is 10.8.
So then has GST also done reasonably well?
GST is also done reasonably well. It is more or less similar. It's growing at the same pace as it is expected in the budget. Customs duty, again, the government's intent was to do recalibration, and also given that there was a sharp cut in gold duties, the duty on gold. Therefore, overall, the budgeted target was also just 2%, but custom duties have done slightly better than that. In April to October, growth rate is around 6%. So it's basically, as I said, corporation and excise duties that are posing a challenge. But overall, gross tax revenues have been around the same pace as it was expected in the budget, though the notable part is to look at the net tax revenue, which grew at only 0.2% because of the greater devolution that is happening to states.
Right.
We saw in the month of October also the government has given an additional installment. In addition to the regular installment, there has been an additional installment given in October in view of the festival season and in order to nudge states to expedite their capex spending. So therefore, there is a discrepancy, or there is a difference between the trajectory of gross tax revenue and net tax revenue, because net is after netting out the devolution of taxes to states.
Right.
But otherwise, overall tax revenue collection picture looks okay, because there are some taxes that are doing exceedingly
outperforming.
well. Outperforming, and therefore they are covering the shortfall of the other taxes.
Okay, so then what does all of this mean for the fiscal deficit? Because there's another factor that's at play, which is that GDP growth in both Q1 and Q2 has been slower than was initially expected. In Q2, sharply slower than what was initially expected. And the thing is that the fiscal deficit is a ratio of the fiscal deficit as a percentage of nominal GDP.
Correct.
So if your nominal GDP is smaller, then your fiscal deficit will likely look
Yeah,
bigger.
look bigger. Yeah, so that is precisely what's happening in the first half of the financial year, because we have 2 quarters data, and so the budgeted nominal GDP growth is 10.5% for the current financial year, and in the first half the nominal GDP growth stood at 8.9%. That means
Right.
now that for the second half, growth has to be 12% to achieve the budgeted 10.5%, which is again a challenge, and which, as you rightly pointed out, pose a challenge for achieving the fiscal deficit ratios, or
Right.
tax to GDP ratios, and so on. So nominal GDP growth, if it deviates from the budgeted target, if it underachieves, then
Even debt to GDP,
debt to
all
GDP,
of the ratios pegged to, yeah.
all fiscal ratios are benchmarked to nominal GDP. And so if nominal GDP grows at a slower pace, then it would be problematic for the fiscal ratios, all fiscal ratios, and also particularly important, the most looked number, the most keenly watched number is the fiscal deficit as a share
Right.
of GDP, and that could also look, more challenging to achieve, given if the nominal GDP does not pick up as is expected to achieve the 10.5% growth.
Okay, so there's basically a lot of
Yeah, ifs
hope,
and buts.
ifs and buts, but also a lot of expectations on the remaining 5 months.
Yeah, yeah.
There's a lot that has to happen. The government needs to spend more.
Yes.
Revenues
Need to pick up,
need to
right?
pick up. Yeah, there's a lot. So okay, we have a few questions from the audience. Madhur asks, even after the elections, why is the government struggling to spend money?
Yeah, that's a very crucial question, and we talked about that. After election, some part of it can be explained by the excess rains, but in
Right.
addition to that, also there are these deeper problems which need to be examined as to why some of the ministries are doing well in terms of capex spending, but other ministries are not. Is there a case for reprioritization of expenditure? There is a need to review the capex plans and targets for the various ministries to see what is the spending capacity, but definitely there are limits to the absorptive capacity of central government
course.
and state, and therefore all these things need to be taken into account when we think of the projecting the capex targets for the next financial year. So they hold important lessons. What we are getting as in the first 7 months hold important lessons for the budget making exercise for the next financial year. So yeah.
Right. And Vinayak asks, to get our economy to fire on all cylinders to achieve at least 6.5% growth in Q3, can the deficit be higher than was initially budgeted? Do you think the government of India and the state governments together can increase the rate of capital expenditure over the next few months?
Yeah, so that is what it is expected, because that now the pace of capital expenditure will pick up in the remaining 5 months, but it is going to be challenging because 5 months again is a very small time period,
Right.
and each of these capital expenditure plans, they take time to implement, and a very useful proxy is also to look at the capex data from the Center for Monitoring Indian Economy, because it tells us about the unit level data on the projects of government.
Right.
And we have data, it's a quarterly data, so we have data till September. We don't see a very sharp pickup, at least till the September quarter. So it is expected that there will be some traction happening, but again there are limits to how much it can happen. So because for some ministries it is easy, for railways and roads we are seeing that traction is happening, but for other ministries there is a need, and that would have implications for fiscal deficit, because if fiscal deficit, we are able to achieve fiscal deficit, that would be because there would be some savings on the capital expenditure.
Yeah.
So that is again very crucial element to take note of, that if we are deviating from capital expenditure, if we are underachieving, that will have implications for overall fiscal deficit, because again if we look at our non-debt capital receipts, they are also falling short. We've already substantially revised downwards our disinvestment receipts target, but there also we have achieved till now only 24% of the target. So on the one side we have tax revenues, which are, some parts of it are doing well, some parts are not doing well. Non-tax revenue are doing exceedingly well. We have already achieved, a 50% growth rate because of thanks to RBI's dividend and
2.1 lakh crore.
2.11 lakh crore,
Right.
and also good dividends from the public sector banks. We've seen that public sector banks' profitability has been quite reasonable. So non-tax revenue have done well, but non-debt creating capital receipts have not done well. So overall, the receipts position is a mixed picture.
Right.
So a lot will depend on how the receipts pick up and how capex spending picks up, and there is expectation that there would be some underachievement on the capex, and that will help the government might achieve its target or might do even better on its fiscal deficit target.
Okay, so there you go. I couldn't actually sum it up better than she has so far. But basically, the main points are that capex needs to pick up over the next 5 months because they're so far only 42% of what the government has budgeted for the year. And on the other side, things like corporate taxes have fallen, or not fallen, but the growth is a lot lower than again what the government has been budgeting. Income tax, of course, has been growing very, very strongly. So overall tax collections might still look okay, but corporate tax collections are not doing that well. The deficit numbers are the other thing to look at because the slowing GDP growth has meant that it'll be more challenging for the government to meet its deficit targets. So that's another thing that they're going to have to keep in mind. All of this is very, very important because we've gone into the budget making process. The budget is on 1st Feb, and the consultations and all of the budget making process has started. So all of this is really, really timely. But on that note, that's all from us. Thank you for watching.